Let's dive in. We're going to take a look at a moment of unexpected optimism in the financial markets. A brief respite, a chance to catch our breath amidst the ongoing economic currents. On April 9, 2025, a seemingly ordinary day, the markets were poised for just another session of ups and downs. But then, former President Trump shocked the world with an announcement that reverberated through every trading floor. He declared a pause on most tariffs that had been weighing on the economy, a move that took many by surprise and sent shockwaves of anticipation through the financial world. These tariffs had been a persistent drag, casting a shadow of uncertainty over global trade. Instantly, the market soared. A surge of buying activity propelled stock prices upward with remarkable speed. The S&P 500, the Dow, and the Nasdaq all experienced significant gains within minutes of the announcement. Investors cheered, their portfolios suddenly looking a lot brighter. The mood shifted from cautious apprehension to outright jubilation, and Wall Street buzzed with renewed energy and optimism. The trading floors were alive with activity, a stark contrast to the subdued atmosphere of recent weeks. This wasn't just a blip, it wasn't a mere knee-jerk reaction to a fleeting headline, it was a sign, a potential turning point that many had been hoping for. It suggested that trade tensions might finally be easing, paving the way for a more stable and predictable economic environment. Businesses, battered by years of uncertainty, finally had a reason to be optimistic. They had been struggling with higher costs, supply chain disruptions, and the constant threat of escalating trade wars. Now, they finally saw hope for a brighter future, a chance to reinvest and expand. They envisioned smoother trade and better margins, a return to profitability and sustainable growth. The optimism was contagious, spreading like wildfire through the financial ecosystem. It was lifting major indices to levels not seen in months, a testament to the pent-up demand for positive news. And it was especially beneficial for battered sectors like manufacturing, which had been particularly vulnerable to the impact of tariffs, and agriculture, another sector heavily reliant on international trade. Even tech, despite its relative resilience and financials, joined the rally, a broad-based surge that suggested a genuine shift in sentiment. Because when global trade flows freely and efficiently, everyone wins, from multinational corporations to small businesses and individual consumers. But here's the catch. There's always a catch, isn't there? This surge papered over deeper cracks, masking underlying vulnerabilities that still lurked beneath the surface. The market's earlier wobbles didn't vanish. They didn't magically disappear with the tariff pause. They were just masked by euphoria, hidden beneath a wave of short-sighted optimism. It's like painting over a shaky foundation. It's a temporary fix, not a permanent solution. It looks good on the surface, creating an illusion of stability and strength. But the problems remain, waiting to resurface at the most inopportune moment. The market craved good news. It was desperate for a reason to rally, and the tariff pause delivered, temporarily, providing a brief sugar rush of positive sentiment. But as we'll see, the underlying issues were not resolved. The real story is what happened next, after the initial euphoria faded. It's when the market's cracks started to show, revealing the fragility beneath the surface. Let's find out why the rally didn't last and what we can learn from this brief moment of market optimism. Before the tariff pause, let's rewind a bit and remember the environment the market was navigating. It's crucial to understand the context to appreciate the significance of any rebound. We need to remember the anxieties, the uncertainties, and the overall sentiment that was weighing down on investors. The market was on a wild ride, a roller coaster of emotions and unpredictable swings. Daily trading sessions felt like a high-stakes gamble, with fortunes made and lost in the blink of an eye. The volatility was palpable, creating an atmosphere of unease and apprehension. Big drops, lots of nerves. Investors were on edge, constantly monitoring market movements and bracing for the next potential downturn. The fear of missing out, or FOMO, had quickly turned into the fear of losing everything. Inflation was stubborn, refusing to budge despite the Fed's efforts to tame it. Everyday goods and services became increasingly expensive, squeezing household budgets and dampening consumer sentiment. Growth was slowing, raising concerns about a potential recession. Businesses were hesitant to invest and expand, while consumers tightened their belts and cut back on discretionary spending. The economic outlook appeared increasingly bleak, and global tensions kept everyone on edge. Geopolitical risks loomed large, adding another layer of uncertainty to the already complex economic landscape. The world felt like a powder keg, ready to explode at any moment. Then, the tariff news sparked a powerful rebound, a surge of optimism that momentarily lifted the market's spirits. It was a welcome respite from the relentless negativity that had plagued investors for so long. As businesses hoped for stability, and investors dreamed of new highs, the prospect of reduced trade barriers and improved international relations fueled hopes for a more predictable and prosperous future. But sharp rebounds can be fragile, often built on fleeting sentiment, rather than fundamental improvements. It's essential to approach such rallies with caution, and a healthy dose of skepticism. Built on hope, not on solid ground. A rebound fueled solely by optimism can quickly crumble if the underlying economic conditions remain weak. The real issues, the challenges that initially triggered the market downturn, sticky inflation, which continued to erode purchasing power and pressure corporate margins, Fed uncertainty, with the central bank's future policy moves remaining unclear, and shaky profit growth, didn't disappear. These fundamental problems continued to cast a shadow over the market's long-term prospects. The market latched onto one piece of good news, seizing on the tariff pause as a reason to celebrate, maybe too eagerly. The enthusiasm seemed disproportionate to the actual impact of the tariff news, suggesting a degree of wishful thinking. It's like feeling better after one pill, experiencing a temporary alleviation of symptoms, but the illness isn't cured, the underlying condition persists, and the symptoms are likely to return unless the root cause is addressed. The rally was a relief, a collective sigh of contentment after a period of intense stress. But it set up the market for disappointment if more good news didn't follow. The market's expectations had been artificially inflated, creating a vulnerability to any negative surprises. With so much optimism priced in, any new worry could hit hard. The higher the market climbs on hope, the further it has to fall when reality sets in. The big question, the one that every investor should be asking themselves, what would keep the rally going once the tariff excitement faded? What fundamental factors would sustain the market's upward trajectory in the absence of positive news? That's where fading tailwinds come in. The supportive forces that initially propelled the market higher began to weaken, leaving it vulnerable to a reversal of fortune. What fueled the market before? Two things: hopes for Fed rate cuts and wild AI hype. Investors bet big on the Fed pivoting to lower rates, making money cheaper and stocks more attractive. At the same time, AI mania sent tech stocks, especially Nvidia, soaring as everyone chased the next big thing. But now, both engines are sputtering. The Fed isn't cutting rates as hoped. Inflation's still a problem, so easy money dreams are fading. Meanwhile, the AI gold rush is cooling off. Investors are asking tougher questions about profits and sustainability. Big tech firms may even slow their AI spending, rippling through the sector. The initial euphoria is giving way to realism. Without those two tailwinds, the market's rally looks shaky. The party's over. Now comes the hangover. Inflation is still the market's biggest headache. Despite the Fed's efforts, prices remain stubbornly high, well above the 2% target. That means higher costs for everyone, squeezing consumer spending and business profits. The Fed's only tool is to keep rates high, making borrowing expensive and slowing growth. Hopes for quick rate cuts are dashed. The higher for longer era is here. High rates make bonds more attractive, pulling money away from stocks. Companies face tighter margins, and investors get nervous about lofty stock prices. The easy money days are gone. Until inflation is tamed, the market faces a constant headwind. The tariff pause was a sugar rush, but inflation is the hangover. No relief until prices cool off. Well, let's talk PE ratios. Are stocks too expensive? The PE ratio shows how much investors pay for each dollar of profit. High PE, investors expect big growth, or the market's just overvalued. Right now, PE ratios are stretched above historical averages. That means stocks are priced for perfection. Future returns could be modest. If earnings disappoint, high PE stocks can fall hard. It's a warning sign. The margin for error is tiny. Any bad news, slower growth, weak profits could trigger a sharp drop. It doesn't mean a crash is coming, but caution is key. When you pay top dollar, there's little room for mistakes. Watch those valuations. Let's talk investor psychology. The market's mood swings from fear to greed. Tools like the Fear and Greed Index show when investors panic or get reckless. Earlier in the year, fear dominated. People sold, bargains appeared. But after the rally, greed took over. Everyone piled in, chasing gains. When optimism is high, risk-taking surges, but so does vulnerability. Extreme greed often signals a market top. Bad news can trigger a rush for the exits. The mood shift from fear to greed made the market fragile. When everyone's bullish, there are few buyers left to keep prices rising. The stage was set for a sudden shock. Let's get technical. RSI shows if stocks are overbought or oversold. Before the drop, RSI readings were flashing overbought, a warning the rally was overextended. Then, out of nowhere, top AI labs announced a pause on next-gen AI development, citing existential risks. This wasn't regulation, it was a self-imposed halt by the pioneers. The news shocked the tech sector and rattled the whole market. Suddenly, the unstoppable AI narrative was in doubt. Investors panicked, questioning the future of a key growth driver. In an overbought, expensive market, this bizarre news was the pin that popped the bubble. A sharp sell-off followed as everyone scrambled to reassess. Confidence was shaken to the core. As if the AI pause wasn't enough, Moody's issued a negative outlook on U.S. government debt. They didn't cut the rating yet, but warned about big deficits, rising debt costs, and political gridlock. This spooked investors. Higher risk means higher yields on U.S. bonds. Rising bond yields make stocks less attractive, especially pricey growth names. Money started flowing out of stocks and into bonds. Companies face higher borrowing costs, squeezing profits further. The Moody's warning and bond market blues piled more pressure on stocks. With so many headwinds, the market's foundation looked shakier than ever. The sell-off deepened. So, where does this leave us? After all the recent market turbulence and economic shifts, we've seen some significant adjustments, and it's natural to wonder about the path forward. The road ahead is still bumpy. Expect continued volatility and uncertainty as various factors play out. It's not going to be a smooth ride, so buckle up and prepare for some twists and turns. The AI pause, the discussions and debates surrounding the development and deployment of artificial intelligence, Moody's warning about potential economic headwinds and the creditworthiness of various entities, and rising bond yields, reflecting increased investor demand for higher returns in a potentially riskier environment, all hit a market already struggling with inflation and high valuations. These factors create a challenging environment for investors, demanding careful consideration and strategic decision-making. It's a potent mix of uncertainty. Now is not the time for complacency. Vigilance and proactive management are key to navigating these turbulent waters successfully. The market's sharp reaction shows how sensitive investors are to any bad news. This heightened sensitivity underscores the need for a cautious and well-informed approach. Relying on one hot sector is risky. Diversification matters more than ever. Spreading your investments across different asset classes can help mitigate risk and improve long-term returns. Moody's concerns and higher yields won't vanish soon. They'll keep shaping sentiment. These factors are likely to persist for some time, influencing investor behavior and market dynamics. As bonds get more attractive, stocks face stiff competition. Investors may shift their allocations towards bonds, seeking safer and more predictable returns. Watch the Fed and inflation reports closely. Stay informed, be realistic, and focus on quality companies. Investing in companies with strong fundamentals and a proven track record can provide a buffer against market volatility. The market just fired a warning shot. Heed it and navigate carefully. A well-thought-out investment strategy and a disciplined approach are essential for weathering the storm. I'll be here to help you make sense of the madness. Together we can navigate these challenges and work towards your financial goals.